The market is still in a meteoric rise. Can't believe how high it's gone. Let's talk more about it. My name's Adam Anderson, owner and founder of WealthGuard Advisors.
Hello, I'm Blake Anderson, Certified Financial Planner. Thanks so much for joining us.
Thank you for being with us. Hit the subscribe button. We'd love to have you follow us and keep up with what we're talking about. Most of the stuff we're talking about here is for our clients, so they know what we're thinking about. But we're happy you've come to visit us. If you ever want to talk to us, just give us a call. Our information will be at the end of the video, as well as our disclaimers. So let's dive right into the S&P 500, Blake. Let's look at SPY, which is the index for the S&P 500. And let's look at what's happened since March 30th. A 14% climb. Well, if we go to closes day, 13.67. So that is a big climb, and I really want to dissect it down and talk about the components of this.
Yeah, this is the fastest recovery from a 10% correction that the S&P 500 index has ever seen. It was just 11 trading days to make back the 10% correction that we saw after the war broke out in the Middle East. And it is very concentrated. So we're seeing most of this in specifically the tech sector more broadly, but specifically semiconductor stocks.
Yeah, so the overall stock market, the S&P 500 and the NASDAQ are all at new highs, all-time highs. So it's been pretty miraculous. I do want to break down the components though, because as Blake was saying, it's very concentrated, really driven by the semiconductors. So let's talk about growth and value. There's two different styles of investments in the market, and the S&P has some of both of those. One is growth. These are companies that are reinvesting their profits back into growing their company. And the other side is companies that are retaining earnings and then paying out dividends, usually is the definition of a value company. So let's look at how the two are doing. So we're looking at both. Let's look at the growth index, SPYG. And so that splits the S&P 500 in half, growth index. And let's look at this. Over that same period, over 20%. Now let's look at the dividend, SPYD, which is more value over that same period of time, about 4%. So when people say, is the market too high? It depends on what part of the market you're looking at. And so I don't think the market's going to collapse because we still have 80% of the market still performing normally or below normal.
Yeah, it does make for we've been talking about this K-shaped economy, and we're kind of seeing this in a K-shaped stock market, where a lot of the growth in the market is very concentrated. And it makes asset allocation kind of difficult because we want to be involved in these growth companies. We want to be holding these companies that are doing so well. But at the same time, if you're not already in them, it's very scary to be buying at these elevated prices. So it's something we're watching closely. We look for pullbacks and buying opportunities. And with some of these, they just keep going up and up and up.
Well, it goes back to diversification. We want to have some of both. Right now, if we've been overweighted or heavily allocated towards growth, it would have been much better. And I like to drill down even farther. When we looked at the growth sector of the S&P 500, let's look at the SOX, which is this semiconductor index, which is the kind of the leading area. These are the chip makers, manufacturers and this is where all the growth is. That the SOX is up 44% over that same period. Remember, the S&P 500 growth index was up only 20%, blah. And then the value index, which is your more conservative value companies, a lot of banks, pharmaceutical companies, 4%. So but let's drill down even farther. Some of the highlights of the S&P 500 or the SOX index. And let's look at the star. I would have never guessed this, but our own, very local Intel Corporation. It is up 131% in a month and a half, basically. Unbelievable.
Yeah, their CEO, Lip Bhutan, I think is how you pronounce it, has done a wonderful job there turning them around. And for a long time, the company was just sort of plodding in the stock market. Was not doing a whole lot for years. And then just recently, we had a bright turnaround.
Well, one of the
It's
things is that the US government took out a 10% stake in Intel, which is kind of controversial. And also they got some big contracts as they try and reshore the US, secure the chip market in the US. So that has a lot to do with this, that the endorsement of the US government involved in it, and then also contracts with some of these big other chip makers and companies in the US. So I like to say that we saw this coming and we jumped all over it. I knew what was going on. I didn't really trust that Intel was going to make the kind of recovery it did because it's just been such a no man's land for so long. And I've talked to so many Intel Corporation employees that are just been in the house of pain, but it is broken out and it's unbelievable. Another big chip manufacturer, SanDisk, um, going back to a 6-month chart off that low, that's up 114%. So pretty unbelievable. So a lot of people feel that this run has come too fast, too quick, and that it is likely that we will see some kind of correction or pullback. But I would say that correction is going to be maybe seen in that growth sector driven by these companies, which have come so far so fast. Maybe not the rest of the market because we're seeing earnings. Company we're in the middle of earnings season, and we are seeing great earnings. We still have some semiconductor companies that are coming up that will give us some more insight on these. But we still have a number of companies that are coming out with earnings, and so far the earnings have been really good, and, so that will drive the market.
Yeah, would like to highlight, especially when we're looking at SanDisk, obviously huge opportunities for growth here that we've seen, but there's also a lot of risk if you get into the poor time. If you go back to the not even 2 weeks, week and a half there, right at March, that was a 30% pullback in the stock in 7 trading days. And so you should expect getting into a company like this to have similar pullbacks and sort of the downside that comes along with the potential growth.
Yeah, I mean, that's a great point. I mean, when you have companies that run up 100% in 5 weeks or something like that, you should expect to see 30% pullbacks as, you know, common, not unusual for that. So, that's one of these things, don't go and throw all your money into something like this. But for those of our clients that hold it, and if you do hold it, uh, I would continue to hold it because I personally thought that this little lump here was maybe where it was going to roll over, and it has just broken out into even higher highs. And that's often what happens. We see companies go into higher and higher highs. I do want to talk about the conflict in Iran, war in Iran, whatever the president called it, the excursion in Iran. Let's go back to SPY. But I think what has happened is obviously, once this unwinds and the oil is unlocked, we foresee that oil prices come down, inflation comes down, and the stock market kind of the feathers are taken off it and it's going up. Um, and so stock market investors take, they always are buying on the rumors. So the expectation is this going to happen. And I think that's one of the reasons why they're like, why is it going up? It hasn't really ended yet. And it's just, that's the way the market works. People are forecasting and they're investing on what is likely to happen. So I think so when it does end up unraveling and being done and everything, the strait is opened up and oil is flowing more freely and gas prices start to come down, we might actually see a sell on the news type of scenario.
Yeah, and I would recommend you remember that when we see these sorts of shocks to the energy market, this isn't the first time in history we've seen something like this. If you go back to the oil embargo in the 70s, it was probably the most comparable situation where it takes a little bit of time for the rise in oil prices to translate into the rise in energy, which is more directly impacting the wider market. Obviously we see it at the gas pump, but for other energy uses, electricity generation, it takes a little bit of time for those costs to flow through. And so that's something to watch for as the market digests these shocks, it might come in phases where we see the news causes initial movement as people react to headlines. And then once it actually makes it into the financials of these companies, we'll see another movement. So something to look out for in the coming month or two.
So what do you think our strategy should be going forward, Blake?
I'm optimistic. That we've seen, uh, as tensions have been easing to some extent in the Middle East, there's opportunities in the market again as companies could get back to work, goods could start flowing, and especially with the tech sector and the AI adaptation and all that's going on there, that's not as affected by uh, international conflict as some other sectors of the market are. So if you're looking for in these growth spaces that we've been talking about, I wouldn't be too worried about the international conflict.
Yeah. Going back to the earnings conversation I was having a few minutes ago, the earnings are still exceptional. The adaptation of artificial intelligence into your vanilla companies out there is significant. I think that that's going to continue to drive earnings up. And I think the overall best thing to be doing right now is to stay invested and, but to be diversified. You want growth, like we've been seeing, and you also want value. You want these protective things. Yeah, you might give up some on the overall return. Obviously, being diversified is always going to weigh that down, but you're going to have a more stable type of consistent return over the long haul. That's really what we like to do with our clients, what we're doing with our money.
Yeah, thanks so much for tuning in and listening. And I know it is a very volatile time in the market where we see massive swings down and up. Just a reminder here at WealthGuard Advisors, we are a registered investment advisory firm. And part of that is a fiduciary responsibility to our clients, where we're obligated to act in our clients' best interest. We specialize in personalized asset management and financial planning designed around your unique goals and objectives. We work on a straightforward fee-only basis. No setup fee, no exit fees, just transparent pricing for the services we provide. If you're ready to take the next step towards a confident retirement, we'd love the opportunity to sit down and talk with you and see if we could be of service. We're happy to discuss individual investments like we do on this video or your overall financial picture. Thanks so much for watching, and we'll see you next time.
Thanks again for being here. We love you. We'll talk to you soon. Bye.